Let's listen in here on the Fed's decision to raise interest rates by 0.5%. All right, check it out, guys.
At 83, 84 basis points, to me, that's huge. We don't have the positive real rates that we want to see that would help us have that soft landing. And look, I mean, we have earnings coming up. Earnings expectations are continuing to fall. And if you have prices coming down, but yet you have wages staying stagnant, you've got to have productivity in order for earnings to do well. And we're just not seeing productivity either. So wrapping all of these things up, along with a higher Fed funds rate, I think you're leading yourself into a recession sometime.
Very important thing she said, guys. Wages are staying the same even though inflation is skyrocketing, all right? So you want to pay very close attention to that? Check this out.
Down. Demand is not declining. It's just kind of being reallocated from goods into services. So I do anticipate we have a recession in the middle of next year, and then we'll bounce back probably towards the end of next year, ready to go into 2024.
Exactly as I've been saying, guys, we're already in a recession. So it takes the media and the news several weeks to months to process all the information. All right, guys, so this is very important. The Fed is doing a great job, but the only way to combat inflation is exactly what they're doing. Keep on raising interest rates. There's going to be great buying opportunities coming in pretty soon, especially in real estate and the stock market, all right? All right, let's listen in a little bit more.
Again, that's not our base case, but that does strike me as a plausible outcome for a year from now.
Mike, the consumer has been very resilient, like Victoria was just saying. Are you expecting that scenario or that trend to begin to shift as the economy does potentially continue to weaken?
I do. Consumers are still in a pretty good place, right? They've seen rising debt levels, rising credit card usage, but off of low bases. Job growth continues to be pretty solid. There's been some near-term relief here as...
So this interest rate hike was coming, guys, because the Federal Reserve knows that in order to bring down inflation to its benchmark of 2%, it has to keep raising interest rates to be able to combat inflation. If they don't do it, inflation could go rampant for the next couple of years. So consumers are taking on more debt as well. They're opening up credit cards, so we're reaching record levels of consumer debt as well. So that is a negative. What you want to actually see is basically job growth, all right? You want to see job growth, you want to see wage increases so that inflation is less significant, so that the economy could keep on producing great numbers, all right? So if you guys want more updates on the real estate market, the stock market, go ahead and subscribe to the channel. I'll provide you more information about how the economy is doing and opportunities to invest your money to ultimately reach financial freedom. I'll catch you on the next video.